Happy 2025. Great to have you participate in our January version of our webinar regarding sales tax trends and economic drivers. I'd like to welcome in, I think you can see on the screen, my colleagues, Ken Brown and Tracy Vesley. The three of us are principals here at HDL working in California and serving our clients on a quarterly basis with sales tax analytics and budgeting and the like. And we're right now heading right into that season as mid-year is upon us. So I think you're all familiar with HDL. We've been around over 40 years. We have a significant number of municipal clients with a high concentration in California and have been blessed to continue to retain a very high client retention over that period of time. And so we're pleased to be able to be here and provide this information today as part of our services. Let me get right to some data, just some high-level statewide numbers, starting with the third quarter 2024 results. You can see here on the left, as we break down the data by the various industry groups, many of them were negative and not unexpected this quarter. The overall combined result for the third quarter, which is July to September's tax filing period, was down 2.3%. We had estimated back in September that there would be a 1.7% decline. So not a significant variance from our estimate. And on the right, you'll notice as we break the data down into various regions of the state, all of those are negative, maybe more so in some of the rural areas and less so in some of the population centers of California. We have a number of considerations here as we look at the outlook, given the results and where things are headed. We've certainly talked extensively over the last year about things like interest rates, and I'll show you some data on that as well as credit. Those are in a red box because we're still not very optimistic that those are turning the corner yet, where they're favorably going to influence sales tax performance. Consumer spending, particularly related to costs and inflation, has still sat in a cautious status, and that's what we show here. We are seeing falling gas prices, and Ken's going to walk through that a little bit later in the presentation, and how that's affecting things like travel will be revealed for you. So let me just talk about interest rates. I'm sure all of you are tracking kind of what the Fed's been doing. You know, back in 2022 and 23, in the green bars here, you would note that there were 525 basis point increases over that year plus period. And then the rates really paused for over a year. Most recently, there's been 3 cuts in the last 3 meetings of the Fed, totaling 100 basis points. So we see that moving downward, you know, the rates again into 2025, probably just with 2 more cuts, given the more recent comments made by Chairman Powell and what he was indicating would happen on a go-forward basis this year. Income versus spending. So in this chart, there's 2 lines here. There's a blue line trying to show personal income, what's transpired more recently. And then the red line is highlighting consumption, personal consumption expenditures. What's really happened up through the end of 2024 is there's been a pretty strong and surprising health in consumer spending, just generally speaking, as the economists of the world were a little cautious about how people might be reacting to inflation and other indicators. I think what's most important in this slide, and you can kind of see that here a little bit in the blue line, which is the income exceeding the expenditure line, that household purchasing power still remains very solid. It's supported by wage and salary growth, which rose most significantly in the latter part of 2024, more so than it had since March. And thus what is in place today is real income is supporting overall spending. We continue to track things like savings and disposable income. This is measuring really personal income savings rates. And of course, you can tell by looking at the chart, they were in or around the kind of 5% level here as the world went through the COVID crisis, and there was a lot of influx of federal money as well. There was a substantial amount of savings. People really pulled back on spending, but it lasted very short term. And so that cash has kind of been blown through. And now more recently in these prior quarters that you see here on the right, we've got, savings rates that are sitting somewhere in the 4 to 5% range. So kind of back where they were looking at historical averages. Goods and services. So a chart here that's kind of breaking down inflation into three categories. And I'll just at the top here, the kind of purple line is dealing with housing costs, which have grown substantially. And that's a combination, of course, of mortgages, but also rising utility, insurance rates, and other components. That has been way up in the last few years. And even this year, this coming year is expected to rise about 5%. What you see in the dark line here and where the yellow circle is what's happening with goods as opposed to services. And that has really suffered a pretty negative pattern for most of 2024. And so when you look at the red line, which is capturing services, that is really where the CPI growth has occurred and is expected to occur. That's largely where people are choosing to spend their dollars, less so on taxable merchandise. Credit card spending from Bank of America here, we have this chart on the left, and there's four lines in here. I'll just concentrate on the solid lines, which are delineating what is happening with retail, and that's excluding restaurants when you look at this data. And again, comparing that to what's happening with services. And we know, and you're going to hear more of this in the presentation, people are making choices of where to spend limited discretionary dollars in places like restaurants, even with rising costs. We know that transaction volumes are essentially similar in late 2024 compared to the prior year, but people are spending less money on taxable goods. So this has been a 3% increase year over year in November of 24 compared to 23 when looking at the services indicator. And gas prices are certainly having some influence on how consumers are behaving. Last kind of macroeconomic slide here, just look at household debt. And so up in the upper right is kind of just breaking the national debt down really into two parts of that data. The darker blue part here is really everything related to housing. And the lighter redded shade area is dealing with non-housing debt, which I've broken out here in the chart on the left. And it might be a little hard to read that, but I can tell you that, things like credit card balances have grown to record levels. That is listed here in the orange. It's over $1.1 trillion now. Ken's going to talk in a minute about autos and the cost of vehicles, and the borrowing rates have certainly had an impact down here in the green, where that debt cost has also risen. We're noticing an uptick in the aggregate delinquency rates, which are running at about 3.5%. It was interesting to me to also observe how much student loan debt has grown, which is up here in the red on this chart. And so there are households taking on a lot of obligations, and these elevated balances will continue to reveal some stress for many households. This is the county by county data. And so trying to show here, when we look at the 2.3% decline for the quarter, how that kind of played out. There's 6 of the 58 counties that were actually green or positive this quarter, mostly in rural areas. 26 of the 58 counties listed here are actually in the dark orange. So they had losses compared to 3Q23 that exceeded 4% when measuring their Bradley Burns sales tax revenues. This is our statewide outlook, looking at things on a quarterly basis. And so if you run your eye back here, beginning in 1Q23, you will note that we've had 7 quarters and are projecting into an 8th quarter, quarter over quarter declines. And so we've seen a steady drop off. I'm going to show you a little later in the forecast how all of this annualizes out. But what that means is last year there was a 1.3% fiscal year reduction in sales tax revenues on a statewide basis. And given current quarter results and our short-term outlook, we're expecting 0.8 of a decline in this current fiscal year. So that's my introduction and kind of overview. We're now going to run through some of the business groups, and I'm going to turn the presentation over to my colleague, Ken Brown.
Thank you so much, Ken. Appreciate it. Let's dive into it. Let's get into our major industry groups this morning. So turning to the first one of the biggies here is autos. And this slide is really denoting the various positive and negative impacts that are pushing and pulling against what's going on with the auto market. So over on the left, we see some of the positives and a couple of things that are going on there. First of all, there is the interest rates are finally declining, and the average age of a vehicle on the road is now at a record high of about 12.6 years. So certainly at some point, people, even though these autos are lasting longer than they used to, people are going to need to replace those autos at some point. So that's certainly a positive support. Furthermore, the recent election may also juice the market a little bit. As a personal anecdote, I just helped my mom buy a new car just this last November. And so went out to the dealership lot with her. And one of her motivating factors to replace finally her 17-year-old car, which we'd all been begging her to replace for years and years and years, was the fact that she was worried about the potential talk of tariffs, maybe raising prices a little bit in the future. And in fact, there are some reports that auto sales in the fourth quarter were up as much as about 7% nationwide. But as we'll talk about in just a minute, there's a lot of contrasting forces at play, and so that may or may not translate into actual sales tax revenues for various jurisdictions throughout the state. So that remains to be seen. But on the negative side, we've heard interest rates likely to be slow and declining, and prices for cars are very, very high still, even though they have been declining a bit. They're still very elevated, and consumers are certainly stressed. So these are all significant headwinds that will continue to face the market going forward. Frankly, the whole industry performance in the auto grouping has been very counterintuitive. During the pandemic, we saw inventory shortages and a huge run-up in prices as a result of those shortages. And so, as you can see here, basically between the years of 2021, 2023, you see that tremendous amount of increases in the price of a new car. And that led to an absolutely blistering boom in revenue from auto sales during that period, even though counterintuitively fewer cars are being sold. Since that point in time, though, prices, as you can see here, the last couple of years have flatlined or even declined a little bit. And so now we're sort of seeing a retracing of those effects that while auto sales are growing now that there's a little bit more inventory, the price reductions are offsetting those sales increases and actually resulting in slightly lower tax revenue from auto sales, as you're seeing in your own results. And in fact, auto related revenue has now declined for 7 consecutive quarters on a year-over-year basis, which really, as you can see up here, corresponds with this flatlining right here due to these price decreases. And despite that, prices are still very expensive, and combined with high financing rates, that's really hurting sales revenue. And so as a result of all those contrasting forces, I put together this slide because this is probably just about the most economically volatile, sensitive major industry group category that we have. And I really like to talk about it because I think it really tells a good story about the overall California economy and also where we are within that. And so let me explain this graph to you real quick. The blue line, very simple. This is going back each year. This is third quarter sales results. And the blue line is your actual dollars. These are actual statewide dollars from auto sales that we've been seeing over the last, 10 years, going back to 2014. And you can see here with those price increases, we saw absolutely, I mentioned a blistering rate of growth. And I think that is a great characterization of it, a great word to use, because basically between these 2 years, as you can see, we grew about 26% in a 2-year period in terms of sales tax growth. And that's, again, due to the inventory shortages that we saw. And so as a result, even though fewer vehicles were sold, we saw more tax revenue overall. So really that was an unsustainable level of growth because basically if you look back in history, you go back in time, what you're accustomed to seeing, certainly it's volatile. It'll go up and down a lot more than typical the average, but you're going to see on average over long periods of time about a 4.5% rate of growth in the auto sector. And that's what this orange line denotes, going back to 2014, as if it's sort of a bogey or a target, as if we were growing about 4% each year. And you can see that we were well above that growth rate here in those years, 2021, 22. But the point I'm making by sharing this with you is, and I think this is certainly reflective of the overall economy as well, and where we are at in terms of the economic cycle, is that finally, after going through the last couple of years, these last 7 consecutive quarters of declines, we're actually just about where we should be in terms of that overall trend. So the bottom line is, one of the points here is I think we are, somewhere near the end of this price correction that we've been experiencing. So that's the good news for today. But before we get there, we have to overcome several major macroeconomic factors. One of the biggies here, not only high prices, as I mentioned, not only high interest rates, but we also have the availability of credit just to begin with. And so here you see overall credit availability for auto loans is actually historically low, going back 10 years. So it's a tough time not only to be able to pay for a loan, not only to pay for a car, but to even get the loan to begin with. So definitely a tough time for the auto industry we're working through. And what does that mean? Well, it means that we're seeing not only a reversal of some of the other trends that we've grown accustomed to over the last few years with price increases and the like, but we're also seeing, in fact, a shift in market behavior. So now we're actually seeing more and more folks buying compact trucks, compact SUVs, and it could be just because there's more available now. No one wanted to sell those things back when there was inventory shortages a couple of years ago. Now they're available. Why not buy them? But I think it's also a reaction to the high prices that we're seeing. So now that is also going to impact the amount of revenue that each agency sees in its coffers each quarter, because people are buying cheaper cars. And so not only do we see that in terms of what type of car, but we even see that in terms of market segment. So this is a sampling that we do every quarter, and we're trying to get a sense of what the luxury market is doing versus the value domestic auto sectors. And my main point here by showing you this here is up top, the luxury market. We just saw a blistering rate of growth again, representative of the overall economy and certainly the auto market on steroids, 22% in 3Q22, sort of the tail end of that growth. But as you can see, the luxury market, and this would comprise Mercedes, BMW, Lexus, Jaguar, Audi, Cadillac, all the names that you're familiar with in that luxury sector, we have basically over the last 5 quarters seen double-digit or close to double-digit declines. And so you are seeing economizing in many areas of the auto market. And so putting this all together, our forecast in 3Q24 was for a decline of 4.1%. As you can see here, we actually saw 4.8%. So we were close, but it was a little bit worse than expected. And that does bring us to 7, as I mentioned earlier, consecutive quarters of decline after that big run up that we enjoyed in 21-22. But again, the good news here is I think we're close to seeing some positive results. In fact, we think we'll see one more quarter of negative returns here in 4Q24. As we complete that 2-year cycle of year-over-year comparisons, and then resume growth that will hopefully very soon reach what we would expect in a typical quarter, somewhere around 4%. Turning to the fuel and service station economic category, just like autos, a lot of contrasting forces influencing the market here. First of all, in terms of supply and demand, California consumption is down, and I'll get to that with a slide in just a minute. But contrasting with that, we actually got supply up. And so in terms of supply, the World Bank actually has predicted for this next year, 2025, a global oversupply of oil in the amount of 1.2 million barrels per day. And in fact, that's only occurred twice before. It's occurred during the pandemic shutdowns in 2020 and also the 1998 oil price collapse. So one of the major reasons for this is that consumption in China has flatlined since 2023 as their economy has suffered some challenges. And at the same time, several non-OPEC countries, and that includes the United States, are talking about significantly ramping up oil production. Again, another important though aspect of this in the push-pull in the marketplace is that California has just initiated some new legislation that will require oil refiners to maintain a minimum inventory of fuel, and also an administrative change that will also incentivize a more rapid shift to cleaner fuels. And so these new changes may result in higher gasoline prices at the pump going forward. And it may also be one of the factors that resulted in the closure just this last month of a major oil refinery in California, which is responsible for about 8% of total statewide supply, which will certainly have an impact going forward. So again, some of these push-pull forces in the marketplace, which will have an impact on pricing. You can see right now, oversupply is dominant. We can see the top line is last year's fuel prices. The bottom line, the darker green down here, is where we're at this year on a year-over-year basis, going from January to December. And we are basically have experienced a 14% drop in the fourth quarter in pricing due to the supply that we have experienced and enjoyed over the last year. And certainly I mentioned falling consumption. You can see that consumption in California is actually down about a little over 1%. And I think certainly one factor that may be playing a role is that the electrification of California's vehicle market. We are constantly seeing statistics over the last year or so that about 25% of new cars, not total inventory, but new cars, is electric. And so I think that certainly may be having a bit of an impact. And so even though the economy is relatively strong in California, I think that that is having an impact as well. And so putting it all together, our forecast for gasoline shows prices continuing to decline until the second half of 2025. But then with the new legislation that I mentioned, also the closure of the refinery, we think that those countervailing forces will ultimately result in a pickup in pricing going over time. Now, construction, building and construction market, again, another interesting market category. We certainly have a shortfall of housing in California and across the country, but kind of similar to autos, prices and interest rates are very high, and that's resulted in a market stall, just like what we saw with autos. But outside of residential housing, there are some industrial use projects, which would include data centers and others that are gaining ground and expected to boost future growth. Commodity prices are also having an impact. Here we see lumber prices. This is certainly a positive and important input into construction pricing. And so you can see some growth in lumber prices. Concrete also very strong, but steel prices significantly lower. So all in, similar to both autos and fuel and service stations, we have now seen 7 consecutive quarters of falling tax revenue from this sector. We expect 2 more quarters of decline before the sector begins to turn around, and as these industrial and other projects begin to break ground going forward. And then finally, the food and drug sector. I've got cannabis up here on the screen. It is a fairly small component, probably about 21% of the food and drug industry's overall taxable receipts. But I have it here because it has been so volatile in terms of pricing, or shall I say, the prices have been moving so significantly that it has influenced the overall trend of the group. You can see here with oversupply, with illegal market competition, and perhaps even declining novelty since legalization, cannabis has been down, and it was down 12% again this last quarter, and we expect that to continue for a little bit. Overall, food and drug sector was down about 2.8%, close to our forecast. But we are looking for impacts from drugstore closures. We've all heard about that with the oversupply and the some retrenching in that industry. And so all in, we think it's going to be a little bit for that to work through the numbers, and also the impacts of cannabis. And then eventually we will see some increases. One interesting thing going on right now, more and more convenience stores as well as grocery stores are offering takeout food. I myself am actually a fan right now of some of that takeout grocery store sushi. It's pretty tasty, it's pretty quick, pretty healthy. compared to going into a restaurant. And so we're certainly seeing some competition there with the restaurant industry for the food dollar. So with that, that concludes food and drugs and the first major industry groups. Let me turn it over to my colleague Tracy now to talk about general consumer goods and the remaining groups. Thank you, Tracy.
All right. Thank you, Ken. I am going to go ahead and get started and jump right into general consumer goods. Really, this is retail, and it's across both brick and mortar, which is in store, and online. So those are the two real components of retail shopping. I love this slide because it's showing where these revenues are generated, how they're generated, and where they're going. So brick and mortar, which is what I'm going to focus on for the moment, these are direct allocations to agencies. These are stores in your cities and counties and jurisdictions, 100% general consumer goods revenue. So that revenue goes right into the general consumer goods group. Now, online, two different components to online or e-commerce revenues. Out-of-state online, these are indirect allocations, got a big boost from AB 147. I'll talk about that a little bit more in a moment. Out-of-state merchandise comprises about 57% of online sales now. All of these revenues go into the countywide use tax pools. These are indirect allocations. You receive them as a portion of your share of your county pool. And then online in-state, this has been an emerging group, actually taking away from the online out-of-state pool allocations. These are direct allocations to agencies that have fulfillment centers in town, considered places of sale or stores. They comprise 43% of online sales now, used to be a lot less. And these are kind of gathered and accounted for in the business and industry tax group. And again, I will focus on that momentarily. The graph off to the side here is really indicating just the change in the relationship between brick and mortar and online. Year-over-year growth in online far exceeds the year-over-year change in brick and mortar sales. This is a good snapshot from Bank of America. Again, punctuating what I just talked about, online versus brick and mortar. This is looking at online credit card spending for retail, no food and gas, but comparing online credit card spending to brick and mortar retail spending. And you can just see in October 24, right here, that delta is about 4%. So red is depicting online, and blue is depicting brick and mortar, and you can just see the growth in online, again, far exceeding that in the brick and mortar spending. General consumer goods has a lot of different sectors within it. Pardon me. These are some of the key sectors. Discount department stores is the largest, and you can see it declined 4.3% for the quarter for third quarter 24. I will emphasize that many of these retailers like Costco and Walmart have fuel stations as part of their operations. All of that revenue gets reported together for the most part, and that will have had an impact on this performance. But when we look at the other sectors within the group, all of them in a decline, the largest in home furnishings, electronics, sporting goods. These are real these are kind of want to haves, not need to haves necessarily. And this discretionary spending is where consumers are certainly pulling back on and seeking value. We'll see that in some of the upcoming conversation as well. This slide is looking at the CPI growth year over year for certain select categories in brick and mortar sales. Most of these are red. So this is a little counterintuitive. While overall inflation remains positive, many of these goods categories have experienced deflation. So their cost is actually inched down a little bit, and in some cases a lot. Look at furniture, down 8.6%. That's going to be a direct translation to sales tax revenues. So combined with perhaps less sales as consumers are really pulling back on those discretionary items, Along with the price of goods coming down, this is where we're seeing an impact on sales tax revenues. The only two categories with a little bit of an increase are footwear and apparel. Another area that we've looked at are retailers providing some forward-looking short-term guidance via their earnings reports. And this is really helpful when we look at, and it just translates directly to the data that we're looking at as well. So when we see Ross, the TJX companies, Costco, Walmart, these are our value retailers. And this is where folks are kind of leaning into right now with regard to spending. Department stores, we're seeing diminished sales, and a couple of the other industries as well. The beauty industry has enjoyed this big ramp up these last couple of years, and it is starting to level off. We're pulling back on that discretionary spending. So companies like Ulta and Sephora are starting to see a little bit of a leveling off in their earnings. Best Buy is a great example of decline. Very discretionary, big appliances, electronics, folks just not popping for those big ticket items anymore. Department stores also on the decline. The one bright spot there is Nordstrom. They are expanding their Nordstrom Rack operations, and that is kind of boosting their outlook. But again, Nordstrom Rack really falls into that value sector. And again, that's where folks are shopping. Looking at our outlook for general consumer goods, and again, this is kind of brick and mortar retail right now. Coming off a couple fiscal periods of decline, last year down 2.2%, really seeing something similar this year. So the last couple of quarters, we saw big declines. Third quarter of 24, down 3.8%. We knew it would be down. We projected it, though, to be down about 1.5%. So it came in worse than forecasted. And as a result, we are adjusting our forecast a little bit going forward, really not seeing any kind of a leveling off until the very tail end of fiscal year 24-25, and then going into 25-26. So 1.9% down right now forecasted for the current fiscal period. I'm going to jump into the pools and talk a little bit more about e-commerce. Again, now we're looking at online e-commerce. This group, the pools, contains a number of industry groups. The two largest are business and industry and general consumer goods. Now, we just got done talking general consumer goods, brick and mortar. This is representing general consumer goods, e-commerce, a portion of it, out of state e-commerce that comes through the pools. And a couple of other groups in this sector, building and construction down, very similar to the brick and mortar result. Autos and transportation, these are private party auto sales. They do not necessarily track with new and used car sales that Ken just spoke about. These are a little bit different. And I will say third quarter is down, and it's coming off of a second quarter that was up. So a little bit of volatility there in this area. This slide is looking at the trends in the countywide pools. The green is representing general consumer goods, and the blue is everything else. So everything else being business and industry, construction, third-party autos, and really looking at the shift in general consumer goods. Used to be the largest by far sector within the pools, and now it's come down a little bit. So when we look at fourth quarter 19 through third quarter 20, this big hump right here. This is AB 147, it's pandemic spending. And then it shifts. Fourth quarter 20 kind of meets, these two lines meet. Companies increase the use of in-state fulfillment centers. So a lot of that revenue shifted out of the pools, went into direct allocation. I'll speak about that again when we talk about fulfillment centers in the business and industry group. And a couple of other changes throughout this timeline here that, again, kind of pushed more revenues out of the pools into direct allocation. But here now in third quarter 24, the last few quarters, we're seeing a little bit of leveling off. The two have now met with regard to the long-term forecast. This report is looking at, or this slide is looking at all online sales allocations. So it's including direct allocation in green. So this is general consumer goods, brick and mortar, and it's business and industry fulfillment centers. These are all direct allocations. And then blue represents the pools, all the indirect allocations. I think the key takeaway here is if you look at third quarter of 20, pools enjoyed 80% of the market share. And then brick and mortar was about 20%. And now fast forward to third quarter 24 and kind of the preceding quarters, it has really shifted and those jaws have kind of closed. Pools are now about 57% of online sales represent that revenue, and direct allocations are about 43%. So really, real big change as far as indirect versus direct allocation. Looking at the forecast for pools, it's actually pretty optimistic. So even though we've seen earlier in 2023, 24, some negative results, overall 23, 24 kind of clocked in at down 0.5%. We are anticipating that e-commerce will continue to boost the pool revenue, and second quarter 24 ended pretty well at 2% growth. Third quarter ended at 3.1% growth. We were projecting 3%, so came in about 0.1% better than what we thought it would be for third quarter. And we really see that continuing. 24, 25, looking at 3% growth in pool revenue and kind of ratcheting it up a little bit going into 25, 26. All right. Let me talk about that third element of online sales. It's all about e-commerce, right? So business and industry, separate tax group, has about 21 different sectors within it, incredibly diverse and eclectic, all the way from fulfillment centers, which is the largest group, about 29% of the group, all the way to film and motion picture related revenues. So big, diverse group. Fulfillment centers, again, 29% of the group. A lot of shifts have happened over time. You can see it here between fourth quarter 19 to third quarter 20. This is AB 147. Really the influx of marketplace facilitators like Etsy, Amazon, Wayfair, etc. Now we have new ones. We have Shein and Temu. Although they're not necessarily impacting fulfillment centers, they're really impacting the indirect online retail. However, in addition, pandemic craziness when we just bought everything we could get our hands on. Fast forward to fourth quarter 20 through third quarter 21 and fourth quarter 22 through third quarter 23, more change. These are shifting local tax out of the pools into fulfillment center revenues. So out of indirect into direct, kind of changed the pot a little bit. This is where we really went from 80-20 to, 50-40, 55-45. And still showing growth in the fulfillment centers. The axis is kind of hard to see here, but fulfillment centers in third quarter 24 grew 5.3%, pretty close to what we were projecting. I think we were looking at 5.5%, so we were right there. Now let's just pull fulfillment centers out of the mix because I know you're tired of me talking about them. And e-commerce. Let's look at some of the other stuff. So business and industry without e-commerce, these are the top business types, the top 10. See a lot of negative here. These top 10 comprise about 54% of the total BNI group, and they're down about 0.6% for the quarter. And some key ones are down: medical biotech, garden ag, warehouse farm, construction equipment, office supplies. Really the biggest increase was in electrical equipment. And the majority of this is related to solar and battery pack energy programs, projects. It's kind of one-time use tax. We saw a little bit of it again in second quarter, and that is why we're seeing that big bump there for this quarter when the rest of the groups really trended down. Industry trends, I've talked about some of those. Fulfillment centers still on the up. Grew in third quarter, anticipating similar growth going forward. The industrial sector is kind of stuck. A headline I have seen repeatedly is manufacturing is in a rut, and they are. Lots of headwinds, tariff stress is real, rates are hurting capital investment, and the industry is really slow to grow right now, still somewhat in negative territory, and there's just very slow growth going forward. Medical biotech facing some of the same headwinds. Interest rates are hurting investments and capital investment. AI is a positive. AI is on the upswing. It's helping with discovery of pharma research and development. So cautiously optimistic in that group. Agriculture, another sector, a lot of headwinds in that area. A recent UC Merced study estimated 50% of farm workers in California are undocumented. That is a pressure on the labor pool in California. And in this sector, particularly, trade practices, another headwind. Equipment sales are in a slump. Big tractor companies like John Deere and Caterpillar forecasting big downturns in their sales. And those are direct sales tax impacts to us in California. The one big positive again is AI. Ag tech is on the upswing. Definitely an answer to some of these other headwinds as well. Looking at the forecast for the B&I group, fulfillment centers are helping a little bit offset the declines in many of the other sectors. Truly looking at flat outlook for 24-25 right now. Zero growth. A little bit up, a little bit down, but the bottom line for the year will be about zero. At least that's where we are right now. Coming off growth the prior two fiscal periods. And then looking forward, 25-26, hoping to see that growth again. Fairly moderate, as there are certainly a lot of headwinds in these individual sectors that we need to plow through. Okay, I'm going to shift entirely and move into food and hotels and entertainment. Restaurants and hotels has been the one bright spot in sales tax reporting these last few years, as other groups have seen negative growth, just kind of coming down off of those big highs during the pandemic and post-pandemic. Restaurants has continued to grow, albeit now we're seeing a slowdown. Still positive, but definitely a slowdown in that growth. Menu prices and foot traffic are a big part of that. Operating costs continue to rise, and restaurants are having to increase menu prices to keep up with these costs. They've modified hours, increased automation, changed portion sizes, scaled down options. But the rising costs have really been a tipping point, and folks are certainly eating out less than they used to. We're seeing an uptick in closures. Many of these chains are closing underperforming stores. And then, of course, legislation, both SB 478, which does not allow restaurants to add fees on the bottom of the check. Now they're being rolled into menu prices. And AB 1228, which went into effect April 1st, 2024, requires fast food restaurants with more than 60 stores nationally to pay their workers a higher minimum wage. It was set at $20 at that point, yet it will increase with the cost of living. So this is impacting menu prices. By June, the average price of a fast food meal in California rose 7.5% compared to the national average of 3.1%. Consumers are leaning into value, not just with retail, not just with cars, but also with restaurants. And as the quick service dining prices have gone up, and the delta between quick service and casual dining narrows, folks are turning to casual dining. The one positive in this group is kind of travel and visitation. So the hotels and entertainment venue component, folks are looking for experiences. Visit California is forecasting a 6% growth in travel spending in 2025. This is an increased projection over their prior 4 and 3%. So really seeing a lot of positive activity. We're going places, both domestic and international, and this has been a positive in the sales tax group. I mentioned AB 128. This slide just kind of tells that story. You can see up here at the top, year-over-year growth for these last 2 quarters where AB 1228 came into play, lower than in preceding quarters. This part of the slide is looking at employment, comparing California employment September 23 through June 24 to the rest of the nation. And you can see a decrease in California of 1.1% compared to growth in the nation of 1.6%. So certainly labor has been a challenge in California and part of the cost structure. And then over here on the far right, not much explanation needed here. Menu prices in April 2024 compared to the prior month. California versus the nation. Wow. California prices much higher. Definitely trying to absorb all these cost increases, and that has driven those menu prices much, much higher. The last element of that is foot traffic. And this report is looking at quick service burger chains, so McDonald's, Burger King, Wendy's, Jack in the Box, and In-N-Out, and comparing year-over-year change in visits versus the national average. And so the bright blue-ish, purple lavender-ish bar is February through March of 2024. This is pre-1228. Mostly growth, a little bit of a decline for In-N-Out. And then when we look at April through May of 2024, a much big, declines for all of these chains as the cost of operations has certainly escalated and impacted operations and sales. Looking at the forecast for restaurants and hotels, still optimistic, albeit much lower of an increase. You can see 22-23, a big 9.2% increase in sales tax in California. That tempered a little bit last year, 23-24 clocked in at 2.2%. Our current fiscal year forecast is 1.2%, so much lower growth as restaurants really begin to grapple with the cost of services, labor challenges. It will get better. We anticipate it will get better toward the end of the fiscal year, going into 25-26, but really looking at this fiscal year being relatively flat for restaurant and hotel growth. With that, I'm going to wrap it up and turn it back over to Ken, and he will take us home.
Thank you, Tracy and Ken, for walking us through all the various segments and industry groups and the underlying trends that are influencing the outlook across each of those 8 sectors. I wanted to just spend a moment here and show you kind of rolling up the data of what we've just talked through for the last 40 minutes or so and putting that into a statewide set of numbers. This is just looking back in the gray bars here several years. You'll note, while at the onset of the COVID crisis, there was going to be an assumed maybe substantial loss in sales tax revenues. In fact, at the end of that 1920 year, it turned out that impact only caused a statewide decline of about 2%. And then a lot of, as I said earlier, money that was saved, money was handed out at the federal government to help keep the economy moving, and just people's desire to get out, spend, and do things. Had a couple of double-digit year increases that has moderated off. We ended up this preceding fiscal year with, as I mentioned earlier, a little over a 1% decline. And when we roll up all of the groups for the year, we are expecting an 0.8% reduction this year. I think it's interesting in this chart to also look at, if you kind of look back and think of 18-19 as a pre-COVID year of sales tax revenues and look at where they are even now with a projected decline of about 1%. It's still a substantially larger amount of overall statewide Bradley Burns sales tax revenues compared to several years ago. And inflation, I would argue, and really the Wayfair decision loading in a lot of new taxpayers were probably the two drivers that have really kind of reset the base. And when you look out here in the outlying years, we are continuing to forecast kind of traditional or normal growth patterns year over year in the 2 to 3% range. So maybe just some takeaways or bullet points for you as you think about this at the local level. So whether you're a city, a county, a special district that's on our call today, it's likely that you're not going to see sales tax gains in the current year, and they're really not going to happen until fiscal year 25-26. Of course, that's going to look different for each jurisdiction, depending upon the composition of your taxpayers and your businesses. But overall, and we're right in the middle, my colleagues and I are right in the middle of rebuilding budgets with this current data and this outlook. And we're anticipating that is going to be the case for a majority of agencies. While there might be an emotional attachment to interest rate reductions coming down, they're still up. And they're certainly up even today, much higher than they were in a pre-COVID level when, frankly, money was pretty cheap. And so we don't think these 100 basis point reductions are going to have an immediate effect or surge in sales tax growth in the short term. There are national policy changes coming. We've talked about tariffs and other things and other economic factors that we think are going to influence overall sales tax generation. Ken touched on service stations and all the moving parts and components that are going on there. We would expect that to be pretty rough through the first half of this fiscal year. And that's going to have an overall effect, obviously, on the bottom line. Really, across a number of these business groups, expect consumers that I think are still very jittery about the economy and where it is headed, are going to be looking for things that meet their household budgets. So that's getting down to values and price points, whether that's involving grocery spending, eating out at restaurants, or buying taxable merchandise. And then for a number of years now, we've seen this kind of shopper behavior shift away to some extent from brick and mortar and e-commerce growing. I just saw an article this morning that holiday e-commerce spending nationally was up 6.7%. So I think that's a further confirmation that people are choosing to buy that way. And given the complexity of the way dollars are allocated with online ordering, as Tracy walked through, we think there'll be some stress points for some brick and mortar locations and stores, but that will also create some opportunities and some challenges when those vacancies do come about. We wanted to give you a little heads up. We're putting together here on the left a link, and there's some information here regarding AB 2854, a new law that was passed in this last legislative cycle. It's requiring local agencies to provide a series of information to the California Department of Tax and Fee Administration, who oversees sales taxes. And this is focused on sales tax sharing agreements. And so there's a desire to have a repository in one place on a statewide level of capturing information about to whom those payments are made and how much, et cetera. There's work being done. We are putting a publication together that we're releasing to help explain this in more detail. The CDTFA held a workshop in the middle of last month in December. There's still some details they're trying to work out about exactly how will this process unfold, what kind of forms will have to be filled out. And even if agencies that don't have tax sharing agreements would still need to fill out something or comply with the law by stating they have nothing to report. So some of that isn't known yet, but as it's made known, we're going to make that available to you. It is important to kind of look at this legislation and understand if you're not compliant with whatever the requirements are, there are some penalties for enforcement. This I should have put on this slide, but this takes effect April of 2025. So make note of that. And then lots of ways to stay informed with all the things that we do. You can subscribe to our newsletter. That would keep you up to date on legislative issues, economic forecasts, headlines, and the like. So there is the ability to do that. In the chat, we have that available for you. And we're at the home stretch here, really ready to take any questions. I don't see any in the chat room, but or in the Q&A box, but we are, the three of us would welcome if you have any questions that you'd like us to cover.
How many instances of businesses leaving California have you heard of?
I guess I would answer that. There's probably some headline things. Maybe I'll answer it this way. So one of the ones that comes to mind is Chevron, which had a big, in Contra Costa County, where I used to work, had a big headquarters in San Ramon. And the thought was, oh, they're leaving that. What's the impact on the local economy, tax revenues, jobs, and something like that. In talking to city staff, that was already known and kind of in transition. So we know that some of that goes on and continues to go on, but there's also a lot of business investment that's happening in California, particularly now with technology and AI and other things going on. A lot of venture capital money is being invested. So I guess I would close my answer to that by just saying it probably depends on the segment or industry we're studying. There's movement in both directions. Currently, there's businesses opening, retail stores. In some cases, are expanding, restaurants are growing, and other companies may be looking for other places that they feel they will be more successful outside of California. But again, thank you very much. All the best in 2025, and we appreciate your time this morning.
Thank you.
Thank you.